in defining ERP systems, we need to firstly understand that functional areas within ERP systems are interdependent. Okay? When you're talking about operations management, you are dealing with multiple areas, multiple processes within an organization, which will touch multiple departments. Operations is broad. It's not just limited to supply chain, manufacturing, sales, order processing. It's not just limited to that. And in that broadness, you can see that functional areas are interdependent. They rely on each other. So each requires data from each other. So if I'm wanting to, for example, to create a plan to target, let's say I have a specific advert or something I'm going to be running, which is aimed at increasing sales, increasing market share in specific products, I need to understand what the products are, how many I have of them, what the capacity is of manufacturing to make more or distribution to purchase more. So I need to understand all of those aspects. So there's going to be some interaction. And it's pointless me working in isolation if I can't engage with the financial person to say, look, we are looking at increasing our sales by X amount, but it will mean that we have to increase our stock holding by Y amount. Do we actually have the cash to fund that up front in order to get the return of the increased sales? Okay, so the functions are interdependent. And in the language of a business is primarily involved with one thing and one thing only. And this is rooted in economic theory, is based on the principles of every company does one thing only. They either sell goods or services to the marketplace. That's all. It's as simple as that. Okay? So we can understand that there's a lot of functions that are required in order to ensure that a company does that effectively. A lot of planning, a lot of strategic intent behind it, a lot of monitoring, a lot of decisions to be made around it. And that's only possible if I actually have inputs from a whole lot of areas. So we are expecting that ERP systems provide us with a view which is interdependent across a whole lot of functional areas. Next, enterprise resource planning. That's what it stands for, ERP systems. And it's core software utilized by companies in order to coordinate information in every area of the business. By its very acronym, it's enterprise-wide across the whole organization. And it is about planning those resources. So yes, it's to help manage company-wide business processes. And the way we do that is by providing formalized processes that are congruent with the way that the companies want to operate, provide a structured method, and by doing that we also provide visibility across that integration of all those functions. So we use a common database and shared management reporting tools. Okay? If all the information's in one place and it's accessible, and we have the management and the reporting tools to access that, it's actually limitless as to what information we can provide an organization. Here's the kicker, here's the reality. Often, in engaging with companies, they don't know what they don't know. That's a reality. And one of the key functions is for you to unpack that and to assist them in knowing what they don't know. Okay, so we also want to look at allowing all functional areas to share a common integrated database. Okay, so this is just sharing. This is the platform and the framework by which software assists companies in managing limited resources for the planning of their execution of their functions in the marketplace. We also want to allow accurate real-time information to be available. And that's very important. Information's really, the best information is that which is most current. Okay, and it's modular. exclamation mark there. Now we know that in the marketplace there are systems that don't sell their software in a modular fashion, but it does not mean that it doesn't actually develop its functions modularly. Okay? It's just a commercial aspect to how they sell it in the marketplace. And ERP's purpose is about money. And it's embedded in economic theory. So we'll talk about that very briefly. If you look at the definition of money in economic theory, it's made up of three components. The first is the facilitation of trade, exchange. Why are companies? A company's purpose is to sell its goods or services in the marketplace. We know that. We understand that. That's how it functions. Okay? An NGO's purpose will be slightly different. Okay? They are to provide a service for a specific function. And then they've got different concerns. How do I fund it? Now they're looking at funding models for NGOs. So there's a facilitation of trade. We are expecting that an ERP will allow companies to better manage the facilitation of trade, purchasing and selling and manufacturing, providing goods and services to the marketplace. Okay? Second, there is, if you look at money in economic theory, is also measured as a store of value. Okay, so I no longer have to take my goat to the market and talk to the hairdresser and say, will you accept a goat for cutting my hair? That's how trade used to happen. Okay, so now in the market, I know it's a strange analogy, but it's very basic. Now I take my goat to the market and I receive money. I then take that money and I then purchase what I want with that money. So money is the middle manager that facilitates trade. Okay? So ERP, again. Store of value is a measure of what that is. So when we look at a general ledger, we understand that there's a balance sheet. The balance sheet records all the assets, all the equity, and all the liabilities of a company. Okay? Accounting is 800 years old. It was invented by a monk. He introduced the world to the double entry system. Everything's got a balance. Where assets equals equity, liabilities. Okay? So a company really has got a balance sheet, it's got an income statement, and it's got a statement of cash flows. Three things. How am I doing? Am I liquid? Have I made money? Income statement. This is what I've received, this is what I've paid out, this is my profit, and this is my balance sheet, these are my assets. Okay? And it's also a measure or index, which provides price or worth. So in that example, how does an ERP do that for a company? Well, quite simple. I can manage all my pricing, all my costing. I know what I'm going to be purchasing items for. I can manufacture something and then I can tell you how much it's going to cost me to make this item. So there's a price index, a cost index associated with it. Okay. So if ERP systems enable those functions, you can see that what it's doing, it's assisting companies to exchange goods and services in the marketplace. Now we'll talk about efficiencies, because that's not what the purpose is. The purpose is to do that. And those that do it well, companies get better efficiencies from it. Okay. So what I'm going to be showing you here very quickly is this graph. So if this is price of an item, and this is quantity, so we're moving from 0, okay? What I'm going to be very quickly drawing here is, this is what happens in the marketplace, X. And this is called, now I'm drawing a very basic one here, so we are saying that in this scenario, All companies have a place in the marketplace. No one is a monopoly. Goods are freely available, so you as a consumer can purchase from one or can purchase from another. So there's a lot of choice. And you will make that choice determination based on what is of value to you as an organization. So if I want to buy nuts and bolts, there's a lot of companies that provide nuts and bolts. Okay? So what this is called is the supply and demand graph. Okay. So very quickly, if you have a look at these two lines, one of them represents supply and the other one represents demand. Okay? So demand is the consumer. Where do you think a consumer is prepared to purchase items? He's prepared to purchase the most items when the price is lowest. Agreed?
Yes.
But supply is not. If I'm a company, I'm going to sell you this at a price where I can realize a margin for it. Yes? I can make some money on it. So eventually what happens is, in the marketplace, is that this situation occurs. And that middle ground is called an equilibrium. And the market actually dictates what the price should be based on the demand in the market. So as a manufacturer, what do you think is going to happen if I produce items over and above that quantity? Let's say there are 4 companies in the marketplace that provide the same goods. They provide exactly the same. Now, I'm a manufacturing manager at a company, at one of those 4, and one month I take this item and I double produce the item. What do you think is going to happen? That's going to mean that there's going to be more goods in the marketplace and I'm going to realize a lower price. The market will dictate the price. That's simple. So I'm going to actually make less money. So there's that balance that has got to be attained. Now, what ERP systems are trying to do is they're trying to ensure that you balance your supply and your demand. And you do it efficiently and effectively. And by doing that, you gain competitiveness in the marketplace. So what do you think happens if one of those 3 companies doesn't have stock of a particular item? A consumer that normally purchases from that company would just purchase from one of the other 3. So that company is going to lose. But you can't just keep stock indefinitely. Why? Because yes, we would like to facilitate that trade and that exchange. So let's just very quickly have a look at some liquidity issues. Liquidity issues is this. I'm a company and I manufacture these items. Some of it I manufacture, some of it I purchase. Components, batteries. I buy in. I don't make batteries. Other items I might actually purchase, maybe the buttons, etc. Maybe I do all the plastic housing and the electronic stuff I outsource. So let's quickly look at that scenario. I purchase items. And the items arrive. Let's call this day 1. At that stage, when the purchase order arrives, is receipted, I know that I'm going to have to make a payment to my supplier. So maybe I have agreed terms with that supplier that I'm going to pay him here. Let's call it day 30 as an example. So maybe I'm fortunate and I manage to coordinate all of my goods that arrive at the correct time. And that whole coordination of ensuring that all the goods arrive at the right time in the right quantities and I haven't over-purchased, yes, is a requirement. But let's say that they all arrive at the same time and I start manufacturing here. Let's call it day 10. Because I worked out that that's where I'm going to start manufacturing. Now, what do you think I add when I do manufacturing? What do you think it costs me as a business? Labor costs. And there could be additional inputs. Yeah, additional input costs, more material. So you can see that what I've got is I've got a liability to pay someone there. Even if I only pay them there, it doesn't matter. I still have that liability that I need to pay them because I've received the goods. I've added additional costs. And then afterwards what I do is I store it in a warehouse. So there I've got some additional input costs for distribution, warehousing costs, space, rent, etc. Yeah? So you can understand I'm accumulating costs constantly. And then eventually I sell this. I sell this item. Now that customer will pay me, let's say, somewhere out here. And when he does, that's when I'm going to realize my profit on the item, which will cover all my costs, plus I'll make some money. Where do you think the funding comes on this cycle? The faster I can increase the velocity, that cycle, over and over and over into the economy, the faster that people are getting paid, the faster suppliers are getting paid. And by doing that, you are increasing liquidity. So this is cash flow, this is a liquidity model for an organization. So what an ERP system is trying to do is it's saying, we have got the facilities in place to assist you to ensure that you purchase the right item at the right time in the right quantities in order so you can sufficiently match supply and demand. Even if we just look at a single product, supply and demand, and to try and improve. So what we're going to try and do is we're going to try and lower your stock holding. We're going to try and reduce the number of customer payment days. We're going to try and improve that. By doing all of that, we are going to be improving your liquidity. And by improving your liquidity, a company has got additional cash reserves in order for it to be doing financial planning, investment projects, financial management, growth, etc. The purpose is to provide the facilitation of trade, the store of value, and an ability for you to measure, index, to see what the worth is, what the cost is of prices, of those services and goods. Okay? So think of this as the delivery vehicle for a company to be able to get its goods and services to the market.